Good afternoon, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez. I'm with Mortgage Works, where we have the answers and they're on the house, coming to you from sunny Palm Springs in the greater Coachella Valley area. We've had a wild week in the interest rate and financial markets. So, and as you know, first thing I like to do before when we start the show is talk about what's been going on with interest rates and the bond market. Jeff is going to pull up our rate grid from our website where you can see where we're currently at. And there you are. Rates actually are pretty decent still, but they're not as good as they were going back to last Friday and even Monday. And but as you can see there, we're still in the low sixes on a 30-year fixed conforming loan. The temporary buy downs are up a little bit, and in the 6 3/8, 4 3/8 range, depending on whether it's a 3-2-1 or a 2-1. FHA and VA are holding pretty steady in the mid fives. Same with the 15-year fixed. Jumbos are back to the mid sixes. But these are not as good as they were again last Friday and Monday. And in fact, what's also interesting is I saw an article today that rates are down as low as they've been in a year, and then it quotes Freddie Mac, who released their rate indication today at about 6.47. Well, as you can see, Mortgage Works were better than that. We're at 6.125 for a conforming Freddie Mac loan. So what went on this past 5 days in the financial markets? Because it was wild and woolly. So Jeff's going to pull up the 10-year bond yield, and you can see right now we're right around 4%, 3.99 when this slide was created. But go back to last Friday and look at that drop that we saw going into late Friday into Monday. It was tremendous. In fact, we actually had a point on Monday. We were down under 3.7 in the yield, 10-year yield. That was lower than we saw right after Christmas when we were right around 3.82. And what was going on there? Well, a few things. If you remember last week when I was talking about the interest rate market and the bond market, I had pointed out that the employment numbers that were going to be released last Friday would be very important in terms of determining some direction in rates. And if you recall, what had happened was the number of new jobs was well below predicted. There was 185,000 jobs predicted, but only 114,000 turned out to be the number. And then in addition, the unemployment rate jumped from 4.1 to 4.3%. Well, what that did is it triggered huge moves in the stock and bond market. As you know, probably recall, how could you forget? The Dow Jones Industrial was off 1,000 points, and that weak employment numbers, those weak employment numbers, are what drove this bond yield way down. Like I said, we got under 370, down to around 367. And so what that did is it triggered some fresh recession talk, which is interesting because the economic data up until this point has been pretty mixed and probably with a bias to the economy remaining strong and not really showing any significant signs of weakness. The labor market's been showing a little bit of soft indications, but nothing major. And so this one day, last Friday, those job numbers, and suddenly recession's back on the table, and a lot of observers even talking about, is it imminent? And of course, recalibrating their forecasts for what the Fed's going to do with the Fed funds rate. But as I put on the slide here, are the markets schizo? Of course, I mean that to be schizophrenic. That's where you have sort of disoriented thinking and behavior. Well, the reason I pose that rhetorical question is because on Monday, we had the Standard & Poor's Global U.S. Services Purchasing Managers Index. It came in at 55 for July. That's 18 months in a row of growth. Anything over 55 is a growing services sector. And then also the Institute of Supply Management Services Index also came in strong. It was 48.8 in June, came in at 51.4 in July. So again, stronger than expected. So the services sector of the economy, which by the way is about 70% of our economy, those numbers on Monday, complete opposite of what we saw on Friday. So that's why I pose a rhetorical question. Are the markets schizo? Well, it looks like there is some indication of that. because unfortunately, since then, rates have trickled back up. Again, as Jeff showed you earlier, the 10-year bond's back to 4% when we were under 370 5 days ago. We were briefly on Monday, well, actually, it's Friday, and then even into Monday, we were briefly able to quote and offer 30-year fixed conforming for good parameters, good credit score, under 6, 5 7/8 with no points. Well, unfortunately, folks, that's gone. You can still get 5 7/8, but it's not 0 points. You're going to have some points involved, not a ton of points, but somewhere approaching 1. And so that was kind of a flash in the pan. And now with these conflicting data points, the market sort of once the job numbers settled in, and the market really overall evaluated what's going on, then we've seen it creep up in the bond yields again. And of course, the stock market's been rebounding pretty well the last couple of days. Today, which is also what contributed to the bond yield creeping up a little bit, is initial jobless claims were forecast for 240,000. They came in at 233. So just that little drop, 7,000 less unemployment claims filed, was enough to give another indication, that maybe the job market is not as weak or getting as weak as last Friday's job numbers suggested. So again, if you recall, I've oftentimes had on this slide a quote which I found from an economist literally about 30, 40 years ago, an unknown economist, that on financial markets, they respond with reptilian-like minds to stimuli. Well, I think the last 5 days bears that out very well in the way the market reacted last Friday. It was obviously, at this point, we can all agree it was an overreaction. Now that realism has come back, then again, the stock market's bouncing back and those bond yields are creeping back up. So we'll see where we go from here. There's really not much in the way of economic data at all tomorrow. So we're going to have to wait till next week. And of course, next week, we're back to inflation numbers, the CPI. So that's going to be interesting and possibly exciting. So we'll see how that goes. With that, Jeff's going to come back on, because we're going to have a little bit more discussion on reverse mortgages. And as we've got there, everything about to know about reverse mortgages, but you're afraid to ask. Hi, Jeff.
Hey, how you doing, Art? This is you're right. It's kind of schizophrenic. I was just looking at what's happening in the market, and it's up 683 on the Dow Jones, and NASDAQ is 464. So an S&P is almost 120. It's wild out there.
It is. It's been a wild 5 days for sure. And I would imagine tomorrow will be relatively quiet. Like I said, there's no data points coming out tomorrow of any consequence. So I think we should see the wild and woolly part kind of settle down until we get into next week. And CPI numbers are always, good for some sort of reaction. So.
I'm kind of excited to talk, I'm very excited to talk about this. And I want to preface this by saying I've got a little bit of a personal interest in it. I know most of you probably think I'm in my mid-30s, but I'm not. I'm a little older than that. I'm one of those seniors. And I did have questions about it. And, I want to thank Art for helping me. So I've got a little bit of a vested interest here. But there's a lot of good things going on. But, one of the things I want to ask you about, Art, is, we talk about the baby boomers, and that there's, at 65, which is your number, or 62, that there's like 10,000 people a day turning 62. That just blows me away. 10,000 people a day.
That's right. Yeah, the baby boomers are definitely on the horizon now, and it's a very big group in the population, and that is why actually reverse mortgages, I think, are even more important to talk about and understand. I actually think reverse mortgages are one of the greatest mortgage programs in this country, but at the same time, probably the most misunderstood.
Well, with that, I've got a few questions I want to ask you. I'm going to stop sharing this screen here for a second. And I just want to ask you a few questions about this. It's like, when we think about reverse mortgages, and people that are over 62, I want to talk about what are their primary goals? Like, what are their top goals when it comes to that age bracket? Can you help me out with that? I mean, I think I know you have a bit of a chart that you want to share. Can I bring that up?
That chart, but there's really there's many objectives, but there's three in particular. One is that people want to make sure they have enough money for the rest of their life. That's a big issue. That's probably, in fact, as you can see on the chart, that is the most important issue for senior homeowners, is making sure they have enough money to last their lifetime. And of course, you can see right below that, the second most important is to remain financially independent. They don't want to rely on, the government resources or family members and what have you. They want to remain financially independent. And then thirdly, they want to stay in their home. Those are the three top. We hear it every time we encounter a prospective reverse mortgage borrower. You can see many other goals there on the chart, but those are the top three by far. And that's really what drives most people in looking at a reverse mortgage.
When you talk about that, have enough money to, for the rest of their life, it's amazing how many people I know over the course of the last, say, 10 years, who all of a sudden I find out they're living in a foreign country. They're living in Costa Rica or whatever. And I ask them why. And it's to help solve that number one question. But there's a better answer, isn't there? I mean, it really is a reverse mortgage, isn't it?
Well, it is. And I that's why I say it's a very misunderstood product. So in a lot of cases, folks will end up resorting to something like, moving out of the country to find a cheaper place to live. Heck, I have a brother who lives in Mexico, and that was part of his focus, is that was a less expensive place for him to live. But in reality, in a lot of those cases, I think many of those folks really would not have to resort to that. If they were a homeowner before they moved, if they had equity, they likely had other choices that maybe they didn't fully investigate, and that might have kept them here. But not to say they're not happy where they ended up, but that does drive some people out of the country just because they're having trouble making sure that they can meet these goals.
Let's take a second, and if you will, I'll pull this one up as well. Is like, what exactly is a reverse mortgage?
Okay, very simple. The reverse mortgage, the core product, is a product that is does have some requirements. First of all, you have to be 62 years of age plus. But as I'm going to talk about in a minute, that's actually not entirely the case anymore. And primarily, it's used by homeowners that meet that age requirement and have a lot of equity. We typically recommend you should probably have at least 50% equity in your home or more for a reverse mortgage to work best. The first most important thing to understand is there's no monthly payments required, and I would underline required, because you can make payments if you want to. Interest is deferred. What that means is because if you choose not to make payments, there is interest on the loan, but that interest simply gets added back to the balance. In fact, reverse mortgages, frankly, are the country's original neg-am product, negative amortization product, which is it's become a scary term, kind of a negative term. And I think in part that's why some senior homeowners are afraid of the product, because they remember not too many years ago, early 2000s, the option arms with the negative amortization and belief that it created the real estate market. So that's a concern, but we can explain why that shouldn't be as much of a concern. You do have to stay in your home. It is important. It's only for people who are going to live in their home as their primary residence. We can't do it on second homes. We can't do it on rental property. So you have to maintain occupancy in the home as your primary residence. In fact, if you move out for 12 months or more, let's say you go into assisted living, then that actually creates a default on the loan. So you have to maintain occupancy of the home, and you have to maintain the property, and you have to pay what we call property related expenses, taxes, insurance, and HOA dues if applicable.
Well, as we get older, typically our income goes down. It's just natural. We're not working 40 hours a week. We may have sold our business, whatever it may be. What about those people who, and you've talked about this before, but I really want to dig into this a little bit, of like, okay, you decide you're going to have a reverse mortgage, and maybe based on all the monies that we have coming in, we can't quite cover property taxes, as an example. Is there something that's written into this that helps still say, hey, we can still do this and make sure that you have some money coming out and you can still access your equity?
Right. Yeah, that's a very good point. Sometimes, and we saw this a lot in the past, reverse mortgage, when made, we didn't have what they call a financial assessment review of the borrower. And in some cases, what would happen is they would apply for the loan, they would get the loan, and they would get all the money up front. And who knows what would happen to the money, but they ended up running into trouble maintaining what we call the property related expenses, or even being able to do repairs and maintenance. So now, as part of that financial review, if it's determined that even if the borrower is eligible for the loan, if they're going to have some trouble maintaining these expenses on time and maintaining the property and repairs and so forth, there can be set up what's called a LISA, loan life expectancy set aside, where some of the proceeds are set aside so that some of these expenses can be maintained even as you enjoy the other benefits of the loan. So that's a key part of the process going forward. So
now, are there? It says here for home buyers age 62. Is there anything for home buyers less than 60 or younger than 62?
yes, in fact, this is something that we talk about a lot. We actually have, well, to go backwards a minute, the 62 plus product is the traditional, what we call HECM, home equity conversion mortgage. That's actually an FHA product. That does require that at least one borrower has to be 62. So if there's only one borrower, you have to be 62 or more. If you're married, only one of you has to be at least 62. The spouse can be younger than 62 and you're still eligible. However, the calculation of how much loan amount is going to be available to you is going to be determined based on the youngest borrower of the two. So if you're 70 and you're married to someone who's 55, that's going to affect how much you're going to get on the HECM product. But in addition to that, we offer currently 3 other reverse mortgage products that are not FHA products that you only have to be 55 or older, not 62. One of them is what we call a home safe second. And that's one that actually we're getting a lot of interest in. What a home safe second is, it's a reverse mortgage like product, but as the name implies, it's a second mortgage. So you get that kind of loan not to replace your existing first mortgage. In fact, in the basic scenarios usually involve somebody who's over 55. They may have had a little bit of a change in their income. They have a modest size mortgage on their home. They probably have one of these 2% and 3% rates because they refied 3 years ago. They're handling that okay, but they got a ton of equity and they'd like to tap into that. They got work to do on their home, or they got to pay off some bills. They're running into a little bit more financial tightness, if you will. And they maybe even had trouble qualifying for a traditional equity loan, like a fixed rate loan, what we call a HE loan, or a HELOC, a home equity line of credit. Plus the fact traditional equity loans have relatively stringent credit score requirements. It's pretty much not possible to get an equity loan if you're below 640. So with the home safe second, it meets some of these issues. You're not qualified based on debt ratio. You're qualified based on residual income. That can be very helpful, particularly for a borrower who might be self-employed, where they report very low net income and they can't meet a traditional debt ratio. You can have a much lower credit score. You only have to have a credit score of at least 600. And again, when you get this loan, now this is a fixed rate loan, you get the proceeds all at once, so there's no line of credit involved. But when you get those proceeds, you don't have to make payments unless you want to. Again, I stress that, unless you want to. And that can be a very good tool for that borrower, that homeowner who's got a lot of equity. Again, usually 50% or more is recommended. And you need to get that equity. You've had trouble getting it through the traditional means in terms of these other loan program options. This can be a great option for that particular situation. When you're in particular, when you're between that 55 and 62 age range, when in the not too distant past you didn't have any other options. Now, in addition to that, we have 2 other reverse mortgage products, or proprietary non-FHA products. One's called Home Safe Standard, Home Safe Select. The Home Safe Standard is a proprietary non-FHA reverse mortgage. It is typically a first mortgage. You can get a loan amount up to $4 million. And you can get the Home Safe Standard is a fixed rate product. There's no mortgage insurance. The Home Safe Select also can go to $4 million. And that's a line of credit product. And again, no mortgage insurance. And so those are 2 additional reverse mortgage products that we can offer in addition to the traditional HECM that you have to be 62 at. So when you think about it, we actually have more options for the 55 plus homeowner than just the 62 plus for the HECM product. So any of you who want to start thinking about retirement and planning for retirement earlier than 62, we've got the products that will address that.
Well, Art, I want to pull this up on screen because I think it's important. I want to know, this sounds almost too good to be true, but I want to make sure that people understand, what does it take to qualify for this?
Yeah, you're going to pull this up. Again, this is primarily looking at a HECM reverse mortgage product. At least one borrower 62, as I mentioned earlier. You got to own your home, obviously. It's got to be your primary residence. We recommend that you have at least 50% equity. What happens there is sometimes, in fact, I had an inquiry a couple of days ago, someone who was interested in a reverse mortgage, and so I asked them some questions. What's their home worth? They said 700,000. How much do you own the property? 425. And I immediately said, it's probably not going to work. And the gentleman who was inquiring was not that old. He was like 71, 72. So we have a calculator, by the way, on our website where you can easily get some preliminary numbers. So we use that. I showed him how to use it. And of course, unfortunately, it showed that he would have to contribute a significant amount of money to actually get the reverse mortgage. So it turned out not to be an option for him. Why? Because he didn't have enough equity for the product to work. Properties can be in single family residence, single family detached. That can include what we call a PUD, planned unit development in a gated community. It can be 2 to 4 unit properties if you're living in one of the units. Again, you have to live in one of the units, and condos. And by the way, we can also arrange one of these on a manufactured home if it's fixed to the land. And then again, in terms of qualifying on income, we don't calculate debt ratios. It's financial assessment to determine you're going to have the ability, based on the income that you do have and liquid assets that you have, to be able to maintain the property and the expenses to the property. And again, if it's determined you don't, that doesn't mean you're not going to get the loan, but some of the proceeds will be set aside, that life expectancy set aside, so that those expenses are covered. FICO scores don't matter on the HECM product. So you can be a 595 borrower and still be able to get HECM reverse mortgage. And again, as it says there, no debt to income ratio. So it's pretty easy to be able to get qualified. It's fairly rare for us not to be able to help a homeowner get that loan if they have enough equity on their home. So,
well, this is a question that's come in, and it says, when a homeowner uses a reverse mortgage to preserve financial assets, what does sequence of return risk mean?
Okay. Yes, sequence of return risk. And what that has to do with, one of the, well, let's go ahead and look at this quote. This is from Kiplinger, as you can see. I'm going to go ahead and read it to the viewers, just in case you're having trouble reading it. And what it means is the order in which good and bad years occurred during the distribution stage of your financial life can have a powerful impact on how long your retirement assets will last. Any market volatility, like we've seen lately, at all is going to hurt. But if it occurs in the first 5 years after you begin taking income, there's a significant chance you could run out of money faster than you planned. Your account just won't have enough years to recover. And of course, that goes back to what's the primary goal? Having enough money for the rest of your lifetime. So what is this all about? Well, what this has to do with is, one of the things about a reverse mortgage is there's a tendency out there in the public, consumers, to think that a reverse mortgage is simply a product for a senior homeowner who's having a hard time, financially. They need to access some income just to live on. They want to eliminate a mortgage payment if they have a modest one, because again, they're struggling financially. But there's so much more to a reverse mortgage in terms of what it can be used for. There's much more flexibility. I mean, you can use a reverse mortgage for all kinds of things. Buy a second home, do sort of an advance inheritance. You can pull money out now and give it to your heirs, your kids, for example, while you're still around. You can do, of course, debt consolidation and do repairs to your home and so forth. But one of the areas that reverse mortgages, I think, are underutilized and not well understood is you'll have some folks who own a home, they're handling it comfortably. Yeah, they may have a modest mortgage, or they might be free and clear. In a lot of cases, they have some sort of modest mortgage amount that they are making payments on. They've got a investment portfolio. They go into retirement. Maybe they're now on Social Security only, but that income is not quite enough to live at the standard that they want to. So with their financial advisor, what they'll do is they'll set up, perhaps out of maybe they have a $400,000 or $500,000 IRA or something, or a retirement account, and they'll set up monthly distributions for money to live on when combined with their other retirement income like Social Security. Well, the issue there that can be problematic is you could, drawing that money every month, and if we have a significant downturn in the market, that could help accelerate how soon that money runs out. Mm-hmm. And so in a lot of cases, what we find is a homeowner who thinks they got enough money, oh, they don't need a reverse mortgage because, I got enough money and my financial advisor says it's going to last for 25 years. Well, what if we have a 1987? And the market drops by 40%. Well, that sequence of returns risk comment is about the fact that if something like that happens and you're still drawing money out, even as your portfolio draws down, it's going to accelerate how soon you can run out of money. So one of the things, in fact, we have a presentation that we can send to any homeowners, anyone out there who are listening to this, either for yourself or someone who's a senior homeowner where a reverse mortgage might be a good option. We've got a whole presentation we can give to your financial advisor to show how a reverse mortgage can be used as a strategy to protect your portfolio and, in fact, even help it grow. And the way it basically works is, rather than using a reverse mortgage as a product of last resort, in other words, you get it, but you draw against your portfolio every month, add it to your Social Security, and then we have a couple of major downturns in the stock market. The drawdown of that portfolio accelerates, and then suddenly you're out of money, and now you're grabbing against your line of credit on your reverse mortgage because you ran out of your portfolio. Well, with this strategy, it works a little bit differently. Get that reverse mortgage, get that line of credit in that reverse mortgage set up. You don't have to draw on it right away. Keep drawing on your portfolio each year when the market is up. But if there's a down year in the market, rather than drawing out of your portfolio, then draw on the reverse mortgage line of credit instead. And so if you do that, back and forth that way, most years you're going to draw from your portfolio when each year if it's up. But on those, unique years when your portfolio, the market's down, then draw on your reverse mortgage line of credit. That's going to help preserve that portfolio from running out, and in fact will help facilitate it continuing to grow. And at the same time, the unused portion of that line of credit in your reverse mortgage will continue to grow as well. So this presentation will show someone, a financial advisor, who can then share it with their homeowner, their client, how using a reverse mortgage as part of a strategy to preserve your assets can, at the end of 20, 25 years, you're going to be much better off financially. You're going to have a lot more wealth, both in terms of the access to the line of credit that's bigger on the reverse mortgage and a much larger portfolio balance because you preserved it by using the line of credit in the HECM reverse mortgage to help preserve it and help it grow.
That's a great. Yeah, I was going to say that's a great strategy. I like that because it's like you have both of them working. As long as this one over here in your portfolio is doing well, keep using it. Don't touch the reverse mortgage unless that downturn happens. And now you're not hurting this over here that keeps growing.
Exactly right.
In a positive way. I love that idea. Well done.
Yeah, because the whole point of it is, see, that actually appeals to those folks out there who are senior homeowners. They got a lot of equity, and so they don't think they need this kind of product. We're starting to see more and more, it's getting more understood that those, they're generally people, in a lot of cases, have pretty good level of wealth, that doesn't mean that this is not a good product for them. They can use it as a financial tool to actually build their wealth even more, which is then going to even prepare them even better to pass that wealth on to their heirs when they vacate the home.
I love that. I learned a long time ago, and I'm not giving anybody any advice on investing, but I always said, when you invest borrowed money, your return is infinite.
That's right.
So that may be a clue.
Yeah, exactly right.
Well, this is great. Now, I want to give a little bit of a plug here because a few weeks ago, my wife and I sat down and there was a couple things we wanted to do to our home. We wanted to put a new roof on it and have it painted. And yes, in the conversation, she said, well, can we do something in the kitchen? And I said, well, you cook in there. Isn't that enough? She says, no, I want a new kitchen. So Art was kind enough to take us under his wing, and he's walked us through, and we're about ready. You know, we're not too far away now, I think, from funding that reverse mortgage, and we're not using all of our equity, which is really kind of cool. And but as you say, we get it all at one time. We're using the safe second, and the process has been so wonderful. And I'm sure a lot of that has to do with you, Art. You know, it's like you've got over 4 decades of experience, and you made the whole process easy. The appraisal came today. They were really super nice. They were in and out in, gosh, I don't know, 30 minutes. And it for us, it's like we didn't have to go back and touch any of our other revenue, like our savings or our investment portfolio, to do these things. And it's just made it a nice process. So I would recommend somebody that's watching out there to say, hey, get a hold of Art. And if you have those questions, don't be afraid to ask, because Art is very good to work with and very knowledgeable. So I want to say thank you, Art.
I appreciate that, Jeff. Thanks for the pitch.
All right. With that, I'm going to turn it back over to you. I think you have some closing information you want to talk about. So have a great weekend. Hey, you know, today was a little cooler. It was very nice outside. I don't know how long it'll last, but get out there and take advantage of it. Thanks, Art.
Okay, thanks. Thanks, Jeff. Take care. Okay, folks, now we're going to go into our closing question from last week. As you know, that's a permanent part of our presentation. So I'm going to have Jeff pull up the screen here so you can see what it's about. The question was actually about piggyback loans. Here's the question. We'd like to purchase a home, but don't have a 20% down payment. We've been told that to avoid PMI, that's private mortgage insurance, by the way, we should consider getting a first and second mortgage combo that was described as a piggyback loan. Is that a good idea? Well, actually, let me go ahead and talk about that, although I'm looking at the screen here and I think we've got the wrong information on a different subject. So let me just go ahead and explain to you a little bit about what a piggyback loan is. A piggyback loan combines a first mortgage with a second mortgage. And yes, the idea is to avoid private mortgage insurance when you're putting less than 20% down. So that's the key idea behind a piggyback. But one of the things I would want to point out to you is you got to be aware of a couple things. One is if you're going to use a piggyback option, a strategy that and you're doing it because you want to avoid PMI, the first thing you need to know is it's going to affect what kind of rate you can get on the first mortgage, because these are typically done when you're purchasing a home. And so the issue with a piggyback is when you're going to get a first and a second, because you're going to put, let's say, 5 or 10% down, and you think that's the way to go because you're avoiding PMI, first thing to know is there's going to be what we call price adds or price adjustment factors on your first mortgage. And they can run anywhere from 0.5% of the loan amount to as much as 1 7/8%. And that can add anywhere from 1/8 to as much as 0.5% to the mortgage rate on your first. Now, why would they do that? It's because if you're going to get a first with a second, because you're putting a minimal down, 3%, well, 5%, 10%, so forth, it's considered more risky. And so what it does is it affects the rate on your first, and sometimes substantially the lesser you're putting down and the lower your credit score is. And then the other thing you have to realize is, at least in current conditions, the second mortgage, whether it's a fixed rate second or a home equity line of credit, is those are relatively high rates right now. Now we've got HE loans and HELOCs as low as in the low 8s, but historically that's a fairly high level, especially when you're combining that with a first mortgage that might start off in the mid or low to mid 6s. And when you start looking at the price adjustment factors, when you're doing the piggyback, that rate could suddenly be in the higher 6s, even approaching 7%. And then what's interesting about that, there's a screen right there. So what's interesting about that is I was just talking about the HE loan rates and the HELOC rates. In the current conditions, a first in the 6s and the HE loan, HELOC in the 8s to 10s, what you're going to end up finding is that in a lot of cases, the result in terms of monthly payment is probably going to be worse than if you just took a 95% purchase loan or a 90% purchase loan and went ahead and took on that PMI cost. And I show you an example here on a PMI rate for a 720 credit score. It ranges from about 0.87% of the loan amount to 0.23% of the loan amount. That's paid annually on a month. Well, it's paid on a monthly basis. Those are the annual calculations. Again, 0.87 to 0.23 with down payments from 3 to 15%. And if you do the math, what you're going to find is that getting that loan with PMI is probably going to be a better overall monthly housing expense than getting the piggyback loan, mostly because of current conditions. Back when first mortgage rates were lower, and in particular when HELOC rates were much lower, a piggyback was more effective because of the lower rates involved at the time. At today's higher rates, a piggyback doesn't usually work as often. Plus the fact when you get the PMI, remember, you can cancel PMI after a minimum of 2 years. There are certain conditions for that. So then you can get rid of the PMI at a later time. If you get a piggyback loan later on, when you get more equity and rates go up, you're just going to have no other option except to refinance the loan. With a straight loan with PMI, you at least have the chance to cancel that PMI in the future, and you might have a good rate on that first where you're going to keep it on a longer period of time. So the conclusion is accepting PMI is a better option than a piggyback under current loan conditions. So good questions. I hope that'll help shed some light on that. And with that, we'll go ahead and go to the closing question for next week. Here it is. My spouse and I are looking to purchase a home and are confused about credit scores and which one is used, since our scores are quite a bit different, which I see that a fair amount. In fact, a lot of times with like a married couple, there'll be sometimes some competition about who's got the better credit score. And I get to be the one to deliver the message, and then it's interesting to see the reaction. But anyway, they're asking, how does that work in terms of what do we use for your credit score for qualifying purposes? So we'll cover that question next week at next week's edition of the Mortgage Minute. So with that, I want to say thank you again for watching and listening. Stay cool out there. Jeff's right. I think we're going to be heading into a relatively cool week, at least out here in the desert. We're going to stay under 110, I think, for the next 7 days. So that's good, relatively speaking. So in the meantime, have a good weekend. Stay tuned for next week. Let's keep our fingers crossed on that CPI, that Consumer Price Index, and hope for a low number. In the meantime, again, have a good weekend and stay tuned, and we'll see you soon. Thank you. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. So long. Take care.